So, Bloomberg is now reporting that the surge in stocks that followed the Fed decision proved quite short-lived. Not only was it short-lived, but it was like a joke. I mean, it was like an hour at the end of the day yesterday. Boom, rug pull right after that. This is very different from what we saw in March. In March, we saw a 2-week rally after the Federal Reserve meeting, and it seems like that hopium did not last. People have lost confidence in JPOW. Now, Bloomberg is going in here saying that just after a day after notching the biggest rally in 2 years, the S&P 500 headed towards its worst session since June of 2020. Remember, June of 2020 was actually when we had sort of a summer crash because we ended up getting a resurgence of COVID. We were just getting ready to reopen after May, and things were looking really good in markets, but we got this new surge, and it was like, oh no, second wave fears. You know, this was well before Delta, right? 95% of companies in the S&P 500 are down. When we look at the heat maps, they're just all red. The NASDAQ 100 is on track for one of its sharpest U-turns ever. And that's kind of interesting to look at because when you get these sorts of volatile movements, you know you're in a bear market. These are the definitions of bear markets. In fact, let me give you the times that we've had these sorts of swings before. And you know, we've seen charts like this before, and we keep getting more and more of them. It's just more and more evidence that we're in a bear market. And all of the times that you've had swings like this before, they've been bear market swings. Again, that's a bad thing, right? So keep that in mind. Like, this is what a bear market feels like, and it doesn't mean it has to end. Personally, I still think it's time to focus on that quantity rather than that price. But take a look at this. Got it, lost it. NASDAQ showing wild swings in 24 hours this year. Take a look at the highlights at the bottom there. So you get a positive 3.5% and a positive 3.4% day. The very next day, you end up down 4.5 and 4.3%. Respective to that prior day there. And look at when these sorts of dates actually happen. Here's the scary thing. This is how you know you're in a bear market. That should be obvious by now, though. Look at the dates. March 13th, 2020, bear market. The 2000 dot-com bubble, bear market. And then the only other time, the 2008 recession, October and November of 2008. Like, if you're looking for an opportunity where it's like, tell me, when can I go buy pain? You got your pain. You got your wish. And I ain't talking about Charles Payne either. I'm talking about real pain, the kind of pain where people are like, I gotta sell just because I'm exhausted. I'm exhausted that things are going up and down. I'm tired of the pain of worrying about my portfolio. So what do? Rather than hold or hodl? They sell. And retail capitulation probably be picking up after we break these psychological support levels, which unfortunately means potentially more pain ahead, or it's an opportunity. It's one of those, that's for sure. Doubts now exist that policymakers will be able to actually deal with inflation, and now we have the real prospect and concern that the market is beginning to price in stagflationary fears. See, some folks are saying, oh no, it's JPowell's fault because he said we're going to do 350 BP hikes, one now and then two thereafter, but that's already been priced in by the market as of Monday. As of Monday, the market had already been pricing in 350 BP hikes. So the market now, turning worse even after the pricing into those 3 BP hikes, is really a way of saying, we just think that no matter what the Fed does, it's not going to be enough. Shares of companies like Etsy and Shopify tumbled on weaker than expected quarterly earnings and forecasts, deepening the concern that the pace of online shopping has slowed and creating the concern that this could be the beginning stage of recessionary changes in spending. Now, fine, but we've also known about the e-com shift away for quite a while. So there's some real questions there as, are we going to see that plummet now in e-com spend end up causing pain in service spend? Or, if people see their wealth disappear, are they going to spend less money going out to movies and restaurants or on travel? TBD on that. Either way, it's pretty painful. So, oil though, interestingly, and this is actually kind of fascinating, oil's actually falling, or it has been this morning. Let's see. Oh, never mind it. You turned back. Okay, never mind. Oil's no longer falling. It was, and now it's actually up about 1%. Nice. Now, one of the reasons, and this was more expected. Usually when the stock market sells up, you get a little bit of this flight to safety. And oftentimes those are commodities, which that was expected. I was kind of surprised that oil was actually selling off, but that was earlier. You get a flight to safety in either bonds or commodities. So it's not a surprise to see now Brent at $111, but this is quite high. We've been hoping oil would head down. Unfortunately, the acceleration of Russia towards Victory Day in their attacks in eastern Ukraine aren't going to help, especially with threats of that German/Russian oil embargo. 10-year Treasury now sitting at 3.05. This is the highest level we've seen all year. We knew we were going to get to 3%, but now the question is, how high are we going to go? Are we going to go to 3.5? Are we going to settle at 3%? 3%, ironically, is starting to look very attractive for a lot of people, and this is why you're getting a lot of sort of buy the dipping in the bond market. But the flip side is, you get by the dipping in the bond market, you have that real potential of getting burned because if you buy the dip in the bond market and then yields rise, you get burned on the value of your bond. So really, it wouldn't be surprising to see more people just say, look, I'm either commodities or I'm cash. You see, every time I say cash, I always think it's funny. People are like, oh, cash, that's bad in inflationary times. Well, wait a minute. Is it though? Because if you're not using the cash to buy stuff like goods and services or energy like oil and gas, then you can preserve cash for buying stocks. And if they're losing value, then you're actually gaining because of inflation. It's kind of a weird, twisted way to look at it, but it's an interesting thing to consider. So let's see what else we have here. We have NASDAQ almost hitting that 6%. I want to zoom in on that 6% there for a moment. Oh, yeah, yep. We're getting to that. Look at that. 309.65 was the low. We got to 309.80. Yeah, you know what's really interesting is ExxonMobil right now is up 41% year to date. That's wild. And I mean, think about Warren Buffett's moves. Even though he's buying the dip on things like Apple, Charlie Munger had been buying the dip on things like Alibaba, they did substantially increase their allocations to stocks in oil, with big moves into ExxonMobil and Occidental Petroleum. And both of those, quite stellar performances. Occidental Petroleum up 97% year to date, while at the same time, the NASDAQ year to date is down 22.7%. So hats off to Warren Buffett again with the amazing positioning. Now, another piece of scary news just came in. U.S. retail traffic on a week-over-week basis is down 10.9%. U.S. retail foot traffic fell 10.9% last week from a year earlier, so year over year, right? Which is really surprising because if you look at these week periods, as in like 7-day periods, and we're comparing to last year, we should really be thinking of seeing increases. Substantially fewer COVID restrictions, more enthusiasm to go out and spend. Is this potentially a beginning of the cracking of the consumer? That, wait a minute, we could only take so much pain in the stock market before we finally start spending less. What do we got? Home improvement centers and furnishing stores had a 24.8% decline in retail traffic, and off-price had a decrease of 18%. I think these are usually like your TJ Maxx kind of stores. Beauty was the only one that actually had a gain with 5.4%. Any kind of malls and department stores were down 15.1%. You have U.S. retail traffic overall, again, down 10.9%. Grocery stores down 5.9%. And when you look at, that's the change year over year, which is odd. And when you look at the change week over week, what do you get? Also declines in all categories. Double-digit declines in all categories with the exception of home improvement centers and furnishings, which were down 6.9% week over week. Grocery stores down 9.1% week over week. So on some of this initial data, not such great changes here and just retail in general now. Take a listen to this. Victoria's Secret traffic down 47% year over year. Bed Bath & Beyond, I'm sorry, 47%. Yeah, 47% year over year, week over week, 23%. Bed Bath & Beyond, year over year, down 40%. Best Buy, down 36% year over year. Home Depot, 26.6% year over year. Nordstrom, 18.4% year over year decline. Target, 17.4% year over year decline. I don't know if obviously people aren't spending more money online. And if now all of a sudden we're seeing retail spend go down, folks, this is the recession. This is what it feels like to be in a recession. Because now this is going to solidify probably a bad Q2 result unless for some reason spending doesn't plummet here in May and June. It's kind of a problem because remember, Q2 is April, May, June. Well, if you had good consumer spending going into April, but May and June are terrible, and we're going to lap last year's summer, forget about it. You got yourself a recession. And quite frankly, we might end up being in a recession all year long. Now, so far, the suits tell us, oh, but don't worry. If we have a recession, A, it'll be transitory, and B, it won't be that deep. Yeah, well, recessions still hurt. Two things we know about recessions. Number one, you can see layoffs within a recession. Usually they don't lead a recession, right? That's odd. It usually happens within a recession. We're still not seeing that. In fact, we're seeing a lot of attempts to hire like crazy now, but you have these really mismatched skill sets that we're dealing with. This is something J-Pow talked about yesterday as well, that one of the reasons we have 1.9 open job slots for every unemployed person is because you have this skill mismatch between what companies want to hire and the people who are available to work. So you've got no cracks necessarily yet in terms of like layoffs, but that usually comes right after you see retail spending go down. And folks, we just got our first news that retail spending went to crap here, and I can't justify that one away. And it's not like I'm trying to justify stuff away. I just want to give you my opinion of the straight scoop. I think those productivity numbers are kind of garbage. This morning, we talked about those. I don't think those really matter. I think they're important because they're going to give us a beautiful upside next quarter, unless, of course, retail stops spending. Then who knows? Maybe that's just a leading indicator, which usually it's not. It's quite a lagging indicator. But the point is, there's a retail traffic move. That's scary. And again, if we're in a recession now, what do you want to do? Well, as always, you want to A, make sure you minimize your debt, clear out margin, or have the capacity for clearing out margin if you need to. Like the last thing you want to do is look at your brokerage account and go, there is no way I can empty that kind of margin. That's bad. Like for me, we just did this math with course members yesterday as we went through my portfolio and we were doing peg weightings and that. We are right now, thanks to good old tax day, I'm 2.6 in margin, but closings that I have for some real estate transactions are essentially going to wipe my margin. So I'm going to be at 0. So that means I'm all in, and then that means I'm at 0. Then I've got a few closings coming up after that in about the next 30 days, and I'll have that money available to buy the dip, which is cool because if we're in a recession in Q2, we're going to keep seeing this sort of pain for a while. Now, hopefully, the best thing that we can hope for is that the Federal Reserve actually sees inflation starting to decline, which I have to say, this is where maybe Cathie Wood could end up being right. Look and read that Etsy and Wayfair earnings report. A huge difference from Q1. In Q1, every single earnings report I read said we have pricing power, we're increasing prices, we have multiple price increases scheduled, we are and the consumer's paying it. Now, what are you hearing from Wayfair and Etsy? Whoa there, big guy. Yeah, we're not going to raise prices just to drop them. You know what we're going to do is we're going to keep our prices stable. And these executives are trying to sell it as if that's a good thing. Like, oh, well, we're one of the few who hasn't been raising our prices. This makes us more competitive. No, it means you have no pricing power and you suck. That's bad. That's very bad. The only thing we have left right now. The only thing this economy has left is the consumer spending money. And the fact that retail traffic just had its biggest drop since November of 2020 is very bad, and is something where, again, get out of margin, get out of debt. If you can't take it, then don't be in the market. If you are looking for a way to kind of like separate yourself and your emotions from your stock portfolio, you have to look at the quantity and not the price. This is a very important concept of the Q versus the P. How many shares of Tesla do I have today? How many shares did I have yesterday? Well, I have more shares of Tesla today than I did yesterday. So for me, psychologically, that means my portfolio is actually up because I have more quantity. Obviously, it's down, but guess what? I ain't looking at it. Like, I am not looking at it. Actually, it's been kind of a wonderful thing. When I go to place an order with JPM, because I still haven't gotten off the platform, and I really like the people over at JPM. I call in the order, which is like super antiquated. But it's actually like this really cool thing because then I don't have to open up my brokerage account and see how bad it feels to be down 10% on Tesla in a day. Oh, I'm sorry. It's only down 9%. But anyway, this retail move, very, very bad. Not good. I don't know if this is going to lead us to like, that's it. Is this like the worst of the bad news? Like, is this it? If we keep getting bad news, obviously not. We keep going down. But who knows? Maybe this is just the news that we needed to get the additional capitulation. We rubber band down below that 0% fib. Maybe we can come back up. We'll see, but I'll tell you, I can't sugarcoat that retail data. That retail data is bad. And, there was this thought that maybe it's just e-commerce. No, retail data is not e-commerce. It's literally consumer spending. I'm just going to read the list really quick. Victoria's Secret, Bed Bath, Best Buy, Ulta, Lowe's, Home Depot, Kohl's, TJ Maxx, Nordstrom, Old Navy, Target, Publix, supermarkets, Ross Stores, Walmart, Macy's, Dollar General, Sephora, Gap, Aldi, Kroger. All of them down. Literally every single one of them. So it's not just e-com now. It's also retail now. That's really bad. So what's left? Travel? Planes? But who wants to be in those indebted companies? And then, who knows? Maybe people have their travel plans booked, but then they stop booking new ones. 2022 is the year of the recession, folks. I think the bond market, and I hate to say it, but I think the bond market was right when the yield curve inverted on April 1st. And it's just like, dude, we will have a recession this year. We'll get through it. We won't have a recession then in 2023 because, we'll be lapping horrible comps. And then we'll have the pandemic behind us. And if you could sit there and diamond hand through on quality stocks, generally, and I'm not trying to say that profit-losing companies are not quality, but, according to institutions, they don't want to own any company right now that has a negative EPS. And so those are the ones that are getting sold off the most. Keep that in mind. But, big concerns. These retail numbers, again, like, I want to be able to say something positive. I mean, beyond buying the dip opportunity, there's nothing positive about it. It's bad news. So anyway, there's the news on retail numbers for you. Oh, but if you want to get life insurance in as little as 5 minutes, remember, you can do so by going to metkevin.com/life. You can even Apple Pay and Android Pay for it. It's exactly what Lauren and I use. Check it out. It's not in the link down below, but you could just type in metkevin.com/life.